Hello everyone, welcome to the Capital Intelligence channel. Today, we're bringing you an elite explainer distilling Warren Buffett's timeless investing frameworks for serious investors. Look, if you're looking for high-value insights, and you really want to understand the mechanics of how the absolute best in the business allocate capital, you're in the exact right place. We are going to break down the essential rules that have guided Berkshire Hathaway through literal decades of market turbulence. And more importantly, we're going to see exactly how these very same principles are dictating their real-world market moves right now.
All right, to kick things off, we absolutely have to anchor ourselves on Buffett's ultimate law of capital preservation. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Now, I know that might sound a little tongue-in-cheek, but it actually sets a highly disciplined, almost didactic tone for everything that follows. For Buffett, avoiding permanent capital loss is the absolute bedrock of compounding wealth. It's not about never experiencing a temporary dip, right? It's about ruthlessly avoiding unnecessary risk and protecting your downside first, just so your capital can actually survive long enough to grow.
So, here's our roadmap for today's explainer. We're going to cover the circle of competence, building economic moats, navigating the hype cycle, and finally, Buffett's current market moves. Let's dive in.
Okay, starting with part 1, the circle of competence.
This is really the foundational boundary of all rational investing. It's the ultimate filter for knowing exactly what you understand and, honestly, what you don't. The crucial takeaway here is that the size of your circle, well, actually, scratch that. The size of your circle doesn't matter nearly as much as ruthlessly defining its exact perimeter so you can avoid costly mistakes. Buffett and his late partner Charlie Munger loved this concept because it emphasizes intellectual humility. Inside your circle, you get it. You understand the business models, the competition, you can accurately project cash flows. But outside, that goes straight into the too hard pile. By staying strictly within these defined boundaries, you completely eliminate the risk of blindly throwing money at industries you just can't predictably model.
And this perfectly illustrates his complete rejection of cryptocurrency. Buffett views investing entirely through the lens of value creation. Because crypto fails the traditional criteria for a true currency, it's highly volatile, it isn't widely accepted as a unit of account, and it generates zero internal cash flow or real utility, he views it strictly as speculative gambling, not value investing. He basically likens it to a shiny block of gold. You can stare at it for 100 years, but it's never going to produce anything. It fundamentally sits way outside his circle of competence.
Moving right along to our second pillar, building economic moats.
Think of it like an ancient fortress. Businesses literally need a structural defense to shield their intrinsic value from the relentless assault of capitalism. An economic moat is simply a durable, sustainable competitive advantage. Look, if a company is generating high returns, competitors are inevitably going to swarm in and try to steal that market share. That's just business. A moat is the barrier that prevents them from doing so, which allows the business to reliably compound its earnings over a really long period of time.
I absolutely love this quote. What I love, of course, is a big castle and a big moat with piranhas and crocodiles. It's such a vivid image, right? And it perfectly captures his mandate for formidable barriers. He wants deterrents that actively discourage rivals from encroaching on highly profitable territory. A great product just isn't enough. The business needs a structural advantage that makes it nearly impossible for copycats to replicate its success.
So, what do these piranhas and crocodiles actually look like in the real world? Well, we've got intangible assets. Think Coca-Cola's unparalleled brand recognition, giving them insane pricing power. Then there's cost advantage. Companies like Geico or Costco operate so incredibly efficiently that competitors literally cannot match their low prices without destroying their own margins. We also see high switching costs with companies like IBM. Ripping out their integrated systems is just far too expensive and disruptive for clients. And finally, network effects, where a service becomes exponentially more valuable the more people use it. Identifying these specific structural moats is absolutely key to finding businesses that will thrive for decades.
All right, pillar number 3. Navigating the hype cycle.
Having established our defensive moats, we really need to pivot to the behavioral psychology of investing. Specifically, how incredibly smart people end up doing incredibly irrational things. Buffett discovered this early on, and he calls it the institutional imperative. It's essentially this systemic, lemming-like tendency of corporate managers to just blindly mimic their peers. If a rival makes a massive, overpriced acquisition, the institutional imperative screams that other CEOs have to do the same just to keep up. Projects magically expand to soak up any available cash, and foolish leadership cravings are suddenly justified by subordinates with really complex spreadsheets.
And this destructive mimicry,
It feeds directly into the emotional trajectory of market bubbles, leading to an inevitable burnout. When corporate leaders, and everyday investors for that matter, abandon independent thinking just to chase what everyone else is doing, they turn genuinely good ideas into absolute speculative disasters. They overpay, they overleverage, and eventually, the whole thing just shatters.
This hype cycle usually unfolds in three really distinct stages, known as the 3 I's. First, you have the innovators. These are the visionaries seeing real opportunities and creating genuine value. Second come the imitators. They see the innovators succeeding, so they rush to copy them, usually flooding the market with inferior versions. And third, finally, come the idiots. These are the speculators driven completely by greed who jump on the bandwagon at the absolute peak of the hype, when valuations are totally detached from reality. Look, by the time a trend is recognized by the broader public, it's almost always shifted into that dangerous idiot phase. And that is exactly why Buffett rigorously ignores market hype.
Okay, part 4. Buffett's current market moves. Let's see how all this theory bridges into immediate practice today.
In a massive capital reallocation revealed earlier this year, Berkshire actually reduced its massive, highly successful stake in Apple by roughly 12.9%. Now, to be clear, Buffett noted that Apple is still an incredible business with a massive moat. This wasn't a rejection of the company at all. Rather, he was strategically locking in significant gains ahead of potential future increases to the federal capital gains tax rate. It was just a calculated, rational move to harvest profits in a favorable tax environment, completely ignoring the market's current love affair with tech stocks.
Consequently, by trimming positions like Apple, Buffett noted that Berkshire's cash and U.S. Treasury position was expected to eclipse a staggering $200 billion. That is a jaw-dropping amount of dry powder, and it brilliantly illustrates his ultimate discipline. He is more than willing to patiently hoard capital when equity valuations broadly offer zero margin of safety. He's famously said he'd keep hoarding cash even if interest rates drop to 1%, simply because they won't swing at a pitch unless it is fundamentally attractive. He is waiting for the perfect moment, the right value and the right moat.
And what about the biggest hype cycle of our current era, artificial intelligence? Well, staying strictly within his circle of competence, Buffett views AI with extreme caution. He literally compared it to an atomic bomb, a genie in a bottle. He totally acknowledges its profound potential for massive societal efficiency, but he also sees its terrifying capacity to supercharge scams and fraud. Because he cannot predictably model how this specific industry will generate sustainable long-term cash flows, he outright refuses to speculate on it. He just places it outside his perimeter. Simple as that.
So, as we wrap up this explainer, I really want you to take a second and audit your own portfolio. Look at the capital you are allocating today. Are your investments genuinely driven by a deep understanding of enduring moats and rational valuations? Or are you simply imitating the hype, risking your hard-earned capital outside your circle of competence? The highest value lesson for any serious investor is to build a fortress of rational value and flat out refuse to play that dangerous game of follow the leader. Thank you so much for joining us on Capital Intelligence. Evaluate those moats, define your circle, and we will see you next time.